Have you noticed the recent trends in the stock market? They've been quite intriguing. Let's dive right in. A key highlight in recent times was when the S&P 500 reached a record high. This was indeed a milestone moment for investors and market watchers alike. But what's interesting here is not just the peak, but the steady trend leading up to it. This trend has been supported by a combination of factors such as robust stimulus measures, the reopening of economies, and the rollout of vaccines. However, not all was smooth sailing. Investors around the world were on edge, awaiting Federal Reserve Chair Jerome Powell's speech. The anticipation was palpable, as Powell's words had the potential to sway the market. This just goes to show how much influence central bank policies have on the stock market. Speaking of global markets, the movements have been rather mixed. While the S&P 500 was celebrating its record high elsewhere, European and Asian stocks were mostly on the rise. Yet, amidst these positive trends, there were persistent concerns. The Delta variant, inflation, and supply shortages have continued to be major influencing factors in the market's performance. It's important to remember that the stock market does not operate in a vacuum. It's influenced by a vast array of factors, from central bank policies and global health crises to supply chain dynamics and investor sentiment. This makes predicting market movements a challenging yet exciting endeavor. As we can see, the stock market is a dynamic entity, constantly influenced by a myriad of factors. Now, let's delve into the role of the Federal Reserve and its recent actions. The Federal Reserve, often referred to as the Fed, is the central banking system of the United States. One of its primary focuses is maintaining price stability. Now, what does this mean? Simply put, it's about keeping inflation in check. Inflation, as you may know, is the rate at which the general level of prices for goods and services is rising. Recently, the Fed has been easing back on rate hikes. This is largely due to the decreasing inflation rates in the United States. By adjusting the interest rates, the Fed is able to influence the spending behavior of consumers and businesses. This in turn impacts the inflation rate. Now, let's do a bit of a global comparison. Take the Eurozone and the Bank of England, for instance. They're still grappling with high inflation levels. This is where the role of central banks becomes even more critical. Central banks around the world are tightening monetary policy to combat inflation. This means they're taking steps to decrease the money supply in the economy, usually by raising interest rates. When central banks tighten monetary policy, it becomes more expensive to borrow money. This can slow economic growth and, in turn, slow inflation. So why is this important for the stock market? Well, the actions of central banks, including the Fed, can significantly affect the global economy. Changes in monetary policy can influence investment decisions, consumer spending, and business profits. And all of these factors can have a substantial impact on stock prices. The actions of the Federal Reserve and other central banks play a crucial role in the global economy, and thus the stock market. But what about the protection for your money? How secure are your financial accounts? You may have asked yourself these questions more than once, and rightly so, as safeguarding your hard-earned wealth should be a top priority. In the traditional banking world, FDIC insurance is your knight in shining armor. It covers bank accounts up to $250,000 per depositor. This means that even if your bank goes belly up, your money up to this limit is secure. But what if you're not a fan of traditional banks? Perhaps you're more into credit unions. Well, you're in luck. The NCUA, or the National Credit Union Administration, has got your back. Similar to the FDIC, it protects credit union accounts up to $250,000. Now, let's shift gears and talk about brokerage accounts. These are protected by the SIPC, or the Securities Investor Protection Corporation. It provides a safety net for your investments up to $500,000. But remember, this doesn't mean you're protected from market losses. It merely ensures you won't lose your investments if your brokerage firm fails. However, it's not all sunshine and rainbows in the financial world. Crypto accounts, for instance, lack federally guaranteed protections. This means if you're into cryptocurrencies, you're pretty much on your own. The same goes for some payment apps which may not offer the same level of protection as traditional bank accounts. This brings us to the crux of the matter. It's crucial to understand the coverage and risks associated with different types of financial accounts. Knowledge is power, and in this case, it can mean the difference between safeguarding your money or losing it. Being aware of the coverage and risks associated with different types of financial accounts is paramount for any investor. So, keep learning, stay vigilant, and protect your financial future. Inflation, a term we've been hearing quite a lot lately. But how exactly does it impact the stock market? Well, inflation is essentially the rate at which the general level of prices for goods and services is rising. As inflation increases, every dollar you have buys a smaller percentage of a good or service. When prices rise, and subsequently when the inflation rate rises in an economy, you often see the interest rate rise with it. Now, let's weave this into the tapestry of the stock market. High inflation can create uncertainty in the market. This uncertainty can lead to more volatility and potentially lower stock prices. Why? Because as inflation increases, companies' input costs also increase. Higher costs can lead to lower profits, and lower profit expectations can, in turn, lead to stock prices taking a dip. Moreover, higher inflation means the central bank might step in to increase interest rates, as we've seen in recent years. Higher interest rates mean higher borrowing costs for companies, which can also eat into their profits. It's a bit of a domino effect. On the flip side, some sectors may actually benefit from inflation. For instance, companies in the energy sector might see their revenues increase with rising oil prices. So, while inflation can often be seen as a negative, it's not all doom and gloom. That being said, it's crucial for investors to understand that inflation is a part of the economic cycle. It's not necessarily a bad thing, but it is something to keep an eye on. If inflation is expected to rise, it might be a good time to look at your investment strategy and make sure it's aligned with the current economic environment. Inflation can have a significant impact on the stock market, making it a key factor for investors to monitor. To summarize, we've delved into some key areas influencing the stock market today. We started off by exploring the recent trends that are shaping the stock market, highlighting the steady rise of the S&P 500 to record highs. We then turned our attention to the pivotal role of the Federal Reserve. We discussed how its decisions on interest rates and monetary policy can impact markets, seeing that investors are keenly tuned into statements from Federal Reserve Chairman Jerome Powell. Next, we examined the protections in place for your money outside of traditional banks. We noted the coverage offered by FDIC and NCUA for bank and credit union accounts, respectively, and how SIPC provides protection for brokerage accounts. However, we also pointed out the lack of federally guaranteed protections for crypto accounts. Finally, we looked at the impact of inflation on financial markets. We highlighted the contrasting situations between the U.S., where inflation rates are decreasing, and the Eurozone and the Bank of England, who continue to grapple with high inflation levels. Remember, staying informed and understanding these factors can make the difference between success and failure in the world of investing. Until next time, stay savvy, investors.